Welcome back to What's Hot, What's Not, CRE, your daily pulse on commercial real estate in America. It's Thursday, February 5th, 2026. Today we're breaking down which multifamily class, A, B, or C, is positioned to outperform this year. So, the big question on every multifamily investor's mind right now is, where do you place your capital in 2026 for the best risk-adjusted returns? The landscape has shifted dramatically over the past 2 years, and the winning strategy from 2024 isn't necessarily the right play today. Let's dive right in. We'll start with what's hot. And for 2026, there is a clear, undeniable winner. It's Class B workforce housing. The data is compelling. We're seeing occupancy rates holding incredibly strong at 95.8% nationally. That is the highest across all multifamily classes, and it speaks to the resilience of the tenant base. While luxury apartments see tenants move for concessions, Class B tenants tend to stay longer, which significantly lowers your turnover and marketing costs. Now, let's talk rent growth. While brand-new Class A buildings in oversupplied markets are struggling to achieve even 1 to 2% growth, Class B is projected to hit a much healthier 3 to 4% this year. Why? Because the demand is simply non-discretionary. This is essential housing for working families, for nurses, teachers, technicians, the backbone of the local economy. They need a clean, safe, and affordable place to live, and that's the niche Class B serves perfectly. And there's still meat on the bone here. The value-add opportunity remains strong. We're not talking about gut renovations, but light upgrades, new countertops, stainless steel appliances, modern lighting can drive significant rent premiums and create real value. It's no surprise that major institutional capital is rotating into workforce housing, chasing that stable, predictable cash flow. Now, for what's not. It's a tale of two different struggles at opposite ends of the spectrum. First, let's look at Class A. The luxury Class A market, especially across the Sun Belt, is still drowning in the oversupply from the last development cycle. We're consistently seeing landlords offer concessions of 4, 6, even 8 weeks of free rent just to get heads in beds. National vacancy for Class A ended 2025 at a painful 9.3%, with an enormous pipeline of new units still set to deliver this year. The luxury renter has all the leverage right now. On the other end, we have Class C, which is facing a completely different set of headwinds. These aren't demand problems, they're operational challenges. Insurance premiums on these older assets have skyrocketed, sometimes doubling at renewal. Add to that rising labor costs and the ever-present issue of deferred maintenance. A new roof or an HVAC replacement can wipe out your cash flow for an entire year. And critically, capital access for Class C deals is becoming increasingly difficult. Lenders are tightening their standards, demanding more experienced sponsors and more reserves. The easy money is gone. So, why does all this matter? Because 2026 is shaping up to be an income-driven year. We're in a market where stable cash flow trumps speculative appreciation. And Class B offers that perfect sweet spot. Strong, inelastic demand coupled with manageable operating expenses. The Class A market will eventually recover, but it likely won't be until late 2026 or even early 2027, once supply is finally absorbed. And Class C, well, it requires an extremely high level of operational expertise. It is absolutely not a segment for passive investors right now. So, for the key investor takeaway today, if you're looking for the strongest play in multifamily for 2026, all signs point to well-located Class B workforce housing. Class A in oversupplied Sunbelt markets is a wait-and-see situation. Let someone else take the initial leasing risk. And Class C is a high-touch, high-risk game, best left to seasoned, vertically integrated operators who can control costs and manage intense renovations. Thanks for tuning in. See you tomorrow. Don't forget to like, share, and subscribe. Visit hotnotcre.com to learn more and subscribe to our newsletter.